Good afternoon, everyone. This is Katie Novotny calling in from Premier Marketing. First and foremost, thank you all for attending today. I am thrilled to actually have a friend of mine here from NGL, Lawrence Favenzio. Today, we're going to talk about hybrids. We're going to talk about LTC and how they compete with each other. This is something that I get all the time. I know more and more calls are coming in saying, I want hybrids. And when I send an NGL option, sometimes we have a little confusion. So, want to make sure that we're not turning down the traditional LTC when the clients or anyone else is inquiring of these options. And I thought, who better to go over how they compare and how they stack up with one another and what we need to be doing out there in the field. So with that, Lawrence, you ready to take it away?
Yeah, thanks, Katie. I appreciate it. And thanks, everyone on the line. I appreciate you taking some time. If you joined the couple of other sessions we've done throughout the year so far, we did the first one on how we have some really unique benefits for couples via the joint and policy with the shared benefit amount rider, that third pool. Then we talked a little bit about ways to guarantee your premium on a traditional chassis via our single pay, and our 10-year pay in many states is guaranteed from day one, and we talked 1035 exchange. And now we want to talk a little bit about some other riders we have that kind of make us look and feel and act like a hybrid policy or an asset-based or linked benefit or whatever lingo you prefer to use. Because a few of these features kind of sound a whole lot like a hybrid, but it's pretty interesting that on a traditional chassis, on this EssentialLTC product, we can provide that same value proposition, which is, hey, if you live and you need care, there could be a long-term care benefit. But if you die and you don't need care, there could still be a benefit that goes to your beneficiaries. Or if you think for a second you might even consider canceling this policy, well, you could have a benefit there and get up to 80% of your money back. So very similar to those hybrid or asset-based or linked benefit products, all on this traditional chassis called EssentialLTC, you can provide that same live, die, or cancel value proposition. And the way we do it is via two different return of premium riders. Now, for those of you that have been lifers in long-term care like Katie and I, 10, 15 years ago, and Katie, feel free to chime in if you like, but we talked about return of premium a little differently. Back then, what did we say? We said, nah, don't sell it. It's too expensive. Let your life insurance be your life insurance. So it was pretty much how we talked about it, right?
Absolutely.
Yeah. So today, I want to bring back some lingo you probably heard, and it does the same thing, but I'm going to talk about it a little differently. So we have this rider called a limited return of premium rider. And what it does today, and what it used to on all those products 10, 15 years ago, is it looks at premiums paid, it looks at any benefits received as claim payments, and subtract one from the other. If anything's left, that money goes to the beneficiary. Now, today I talk about it differently because I look at this and I go, well, over the last 10 or 15 years, these hybrid or asset-based products got real popular, didn't they? And I look at this formula you see on the screen and I go, isn't this exactly how those products work? Just that first stack of money is not called a premium. It's called a death benefit, right? And you subtracted every dollar for long-term care claims paid. And if anything's left, it goes to the beneficiary. So on a traditional chassis, you can provide that same value proposition. You're just using different language, right? And much like the true hybrids out there, right, the ones that have long-term care beyond the death benefit amount, much like that, if your claim on this product is much larger than your premium paid, or in the case of the hybrid, the death benefit, the beneficiary in that case would get nothing because you have significant long-term care claims in excess of your premium, or in the case of the hybrid, in excess of the death benefit. So this is the die part of the live, die, cancel, right? And the live, of course, is the long-term care benefits that we've discussed on previous sessions. Well, now you have that cancel part. And I pause here for a second because what I love about this product and how we built it is you can sell just the live benefits. And then you can check the box for limited return of premium, and now you have live benefits and die benefits. Cancel isn't automatically built in unless you check a different box. Why do I like that? Well, statistically, How many people cancel their long-term care insurance? Next to none of them. So why are we going to automatically make them pay for a cancel benefit if they're really unlikely to use it? Whereas with all those asset-based or linked benefit or hybrid products, all three are built into the product. You have to have live, die, and cancel. With us, you can just have live. Check a box, you have live and die. Check a different box, you have live, die, cancel. So that other box is called a limited return of premium with optional policy surrender rider. And what that does is it does exactly what this does. You take the limited return of premium and you add a surrender value to it, which grades up to 80% of premiums paid. And honor after that 4th anniversary, if the person says, I don't want this anymore, I'm walking away, we'll give them 80% of their money back and cancel the policy as long as you have this rider. Now, when do I see this fitting? Well, if you have a big single premium policy, say they put $500,000 into this thing, I could understand they might want an out, and it would be worth it for them to check this box, have the extra cost of this rider, and potentially get up to 80% of their money back if they cancel it on or after the 4th anniversary. But generally, I'm not seeing a lot of people buy the surrender option. Again, look at the statistics. Next to nobody ever lapses their long-term care insurance, so not many folks are buying this unless they're really large lump sum types of policies. Which, by the way, remember, we do have a fully guaranteed single pay, and our 10-year pay is fully guaranteed from day one in 43 states. In the remaining states that have a 10 pay, you could have an increase, but it's only during those 10 years. So again, things that make it look and feel and act like a hybrid. Now, another interesting note as I talk about return of premium and surrender, it's a real executive style benefit, right? It's a nice rich benefit. The 10 pay, a nice rich thing to put on a policy. So if you're talking to a business owner or any executives that say a C Corp, yes, we have these features that look and act and feel like a hybrid, but we do it all on a traditional chassis. So, in the case of a C Corp, generally speaking, you might be able to deduct the entire premium, whereas with a hybrid product, you know you can't deduct life insurance. And the way those products work is you have a life insurance portion of premium and you have a long-term care rider portion of premium. You can't deduct the life part. We are on a traditional chassis. So the return of premium rider is still considered tax-qualified long-term care premium, and you may be able to deduct that entire thing and give them the hybrid style benefits that they wanted with more of a tax play. So something else to keep in mind when you're looking at us with those return of premium and or surrender riders, or even the 10-year pay, which could also help them gain a very sizable tax deduction. So we designed this webinar series to be a shorter soundbite. I think I've been talking for about 10 minutes. I want to take a moment and kind of end where I began and then show you a quick example of how flexible this thing can be with all the things we've learned throughout these 3 webinars. So we've got some really compelling features that allow you to flex and mold this thing into what the client is telling you is important to them. You can play with this and from a traditional aspect, from a hybrid or asset-based aspect. We've got ways to guarantee the premium via the single or the 10-year pay in most states. This thing can be really interesting as you bring it up to business owners with some tax plays or some executive carve-outs, and we do administer to the 1035 exchanges. Now, I'm sure I've used this in all the calls we've done so far, but again, I want to look at our quick quote calculator quickly together to show you, hey, here's what it looks like with and without those riders. And don't bother writing that link at the bottom down. You'll inevitably miss a slash or a dot. I'm sure Katie will send it out after the session, but I want to do a demonstration. So I just came to our quick quote calculator, and I'm just going to run a age nearest 55-year-old couple, male-female couple at our most common rate class. And if you're not familiar with our quick quote calculator, it defaults to pretty plain Jane, straight down the middle long-term care, right? It's $150 a day, 3 years, 3% compound with our shared third pool and a 90-day limit. So when I hit calculate, I just ran a quote. This thing is that fast and easy to use. If you haven't played with it yet, I would urge you to. And it gives you some good imagery, right? It shows you, hey, this person has their pool, the other insured has their pool. If either or both run out, you have your shared benefit. It's going to cost you about $4,800 a year, right? And then it shows you, hey, you paid in your $4,800. You've $500,000 if you add up your 3 pools. And by the way, when you're age 85, Mr. 55-year-old, you would have paid in about 140 grand. You got about 1.2 million in benefits. Well, I've really been hearing a lot about those hybrid products. Well, there's only one that does a lifetime pay, and this traditional product, I can give you that benefit at death if you never need care. Instead of 4,800, it's 76 now. But if you go down here and read this fine print, which you probably can't see, it'll tell you last to die on a joint policy, and if you die and never need care, the beneficiary is going to get the premium you paid. Or if you do need some care, that amount to the beneficiary is reduced by the long-term care benefits paid. So look at your story now. You pay your premium once at issue, same long-term care benefits, add up your 3 pools. But if you die and never need care, every penny goes to that beneficiary. And at age 85, it goes to show you that. Now, if they're concerned about the cancel part, add the optional policy surrender. Now you have a value here that's 80% of premiums paid, because by age 85, they're well beyond that 4th anniversary. And now that's $8,400 a year, right? So about $4,800 for standalone long-term care. Okay, $7,600 for the hybrid style benefits, and about $84 if you want to add the surrender to it. Now let's say it's a single pay client. Well, flip that switch. So now you have a hybrid style live, die, and cancel, fully guaranteed single premium. Costs about $212. Pretty well in line with the hybrid products out there. But what I find interesting is when you can say, hey, Mr. Client, yeah, it costs $212, and we get you those hybrid style benefits you wanted on a guaranteed single pay. But what if I got you regular old long-term care insurance on a guaranteed single pay? Well, instead of $212, it costs you $120,000. That will never get a rate increase. They can never ask for another penny. You have guaranteed long-term care benefits to grow with inflation. And it costs you about $90,000 less. So think about what you can do with that, right? Mr. Client, I can save you 90 grand. And what if we took that 90 grand and we leveraged it in a better way to help you financially plan for your future? So when you put this 120,000 standalone next to a live, die, and cancel 212, at least when I was out there selling, I found most people went to this. And that was a long time ago, because single pay long-term care hadn't been back around very long since we launched this product. I'm talking back in the, I don't know, late 2000s, pre-2010 or so. So pretty interesting stories you can tell. So here's your live premium. Here's your live and die premium, about $193. And here's your live, die, and cancel premiums at $212. Well, what's that look like on a 10-pay, Mr. Agent? Well, you can flip that switch too. It's about $25,000 a year for a live, die, cancel. And in this state, that's a fully guaranteed 10-pay to never get an increase. But good old standalone long-term care will save you about $10,000 a year. Multiply that times 10 years, you can save about $100,000, and we can leverage that in a better way. Beauty's in the eye of the beholder. Some might buy the live, die, cancel. Some might get the standalone long-term care. But utilizing our quick quote calculator, I think it's a really great tool to show both ways to do it. So with that, I think it's been about 15 minutes, which is what we shoot for. Katie, I will pass the baton back to you and see if we have any questions. But folks, I hope you found this session and the past sessions helpful. And you see that NGL's got some great options that are very flexible to help you meet the needs of your clients, and that we want to do all we can to earn your business on a regular basis.
So as always, anyone that has additional questions can feel free to shoot them over in our questions section. We'd be happy to address them. But one question I am getting here is regarding state availability. Is the single premium available in all states?
With the exception of 2 states, actually. So New Jersey and Florida did not approve a single pay. Every other state where the product is available, we do have a single pay available.
Okay. I see some of them coming in here. One is going to be regarding the calculator address. Yes, we will be sending that out along with a copy of this presentation. Another one says, is the single premium fully deductible for a C Corp?
The answer is more than likely. C Corps, whether it's the owner or the employee, you should be able to deduct it, subject to reasonable compensation rules. So, for example, if you have the owner of a company who draws a minimal salary, and all of a sudden they want to buy him a $300,000 single pay, the IRS might have some questions. So that's why I said the answer is more than likely.
Another one in here, Lawrence, is going to be regarding marketing materials. Do you have marketing materials regarding your single premium options?
Marketing, I'm assuming consumer approved materials.
That's my assumption.
So we do have the consumer brochure available that does have some good highlights on the single premium payment option. There are a handful of other consumer materials out there that are available on the website, but I do not believe we have a consumer approved single pay, blurb flyer. But if you use what we do have, there are mentions of the single pay in there. Real quick, just to show you what we do have, if I go to our agent website here and log in, when you go to sales and marketing, you can go to consumer approved materials, and you have the things that are available here. So the one I was referring to was the client brochure or consumer brochure, and select whatever your state is. It'll pull up that brochure, and there will be a section in here that mentions flexible premium payment options. In addition to a lifetime pay, we have a 10 pay, we have a single pay. You can use a 1035. So I would refer to that. There is a flyer as well that does briefly mention some pretty interesting features. Excuse me, I confused that one with an agent flyer. So yeah, I believe the consumer brochure is going to be the best thing for you to use in that scenario.
Perfect. Another one is regarding rate increases. Does this mean with a single premium and a 10 pay, there are no rate increases?
So the single pay is fully paid up on day one. It will never get an increase. It's non-cancelable. We're never going to ask for another penny. As of today in 43 states, my 10-year pay is fully guaranteed from day one to never get a rate increase. The 10 pay is in additional states, but has not yet been enhanced to be fully guaranteed. More of those states will be enhanced probably in the third quarter of this year. So know that state variation listing. But in all states where the single pay is, it is guaranteed. 43 states, 10 pay is fully guaranteed from day one. And there's a few trickle states we're still waiting on. But even there with the 10 pay, they can only get an increase during those 10 premium paying years. If one happens after that, they're unaffected because they're already paid up.
Perfect. Another question is can you explain the 1035 capabilities of this product?
Yeah, so I think our last session would be a great recording to listen to where we highlighted specifically 1035s and limited pay options. But in a nutshell, you can 1035 exchange the cash value from a non-qualified tax-deferred annuity and or a cash value life insurance policy tax-free into paying long-term care premiums. And that includes any of the tax-deferred gains that they never paid tax on. And you still have tax-qualified long-term care benefits that come out the other end. So that is the Cliff Notes 12-second answer I can give you. But if you reach out, I'm sure we can give you the link to the recorded session we did on 1035s and limited pays, which also is probably about a 15-minute highlight session.
Yeah, I'll simply send that out as an addition with all the other things that we're going to include. So I'll just put a note to include that.
Wonderful.
Well, it looks like we have handled the questions. Thank you again, everyone, for joining us. And Lawrence, thank you so much for going through this with us. This is good stuff. Like I said, I know these are questions I get every day. I'm sure they're questions that people are having in the field. So with that, I want to thank everybody for attending. Lawrence, thank you. Thank you. I appreciate it. And we will be in touch regarding some updated topics that are going to be on their way on our schedule shortly. Everyone have a great afternoon.